Welcome to today's deep dive. If you're the kind of learner who, really wants to understand the forces shaping global industries, but you just don't want to drown in spreadsheets.
Right. Nobody wants to just read a spreadsheet.
Exactly. Well, you are in the right place. Our mission today is to execute a really comprehensive deep dive into the surprisingly dramatic Q1 2026 earnings presentation from GE Aerospace.
Yeah, it's quite a story.
It really is. The goal here isn't just to list financial figures. We want to decode what these numbers actually tell us about the global aviation supply chain, the macroeconomic crosswinds we're seeing, and just the really delicate balancing act of manufacturing at this massive scale.
Because the numbers they put out are, frankly, wild.
Completely wild. So here is the hook for today. GE Aerospace just reported an astonishing 87% year-over-year growth in orders.
87%. Just let that sink in.
Right. And they're building a backlog that's now sitting at over $210 billion.
Which is fantastic, obviously.
On paper, yeah. But hidden inside this massive success is this really fascinating operational paradox. How do you handle demand that is growing so fast it actually starts to break your own supply chain?
Yeah, it's the ultimate double-edged sword in modern industrials. I mean, unprecedented growth is the objective, right? But
Yeah.
that same growth is currently the primary threat to their operational stability.
Okay, let's unpack this. Let's look at the sheer scale of the Q1 growth first, because you really have to conceptualize the physical reality of these numbers. So adjusted revenue hit $11.6 billion.
Which is up 29% year over year.
Yeah, and operating profit reached $2.5 billion, an 18% increase.
The services side is where it gets really crazy, though.
Right. Commercial services revenue jumped 39%, and total engine deliveries are up 43%. And specifically, their commercial engines and services division saw a 34% revenue increase and a 23% jump in operating profit.
Yeah.
And we have to remember, a 43% jump in delivering commercial jet engines is not like a software company just shipping more code.
No, not at all.
These are some of the most complex, highly engineered pieces of heavy machinery on Earth.
What's fascinating here is how the internal tension of that physical reality actually shows up in the data. Because while services revenue is up that 39%, their spare parts delinquency is actually up 49% year over year.
Wait, let me pause on that word. Delinquency. That means they're late, right?
Yes, exactly.
Like they're actively missing deadlines to deliver the pieces needed to keep planes flying.
Yeah, I mean, the demand is so robust. Spare parts orders alone are up over 30% year over year since just the beginning of March.
Wow.
So it's vastly exceeding their supply capabilities. Even when they're delivering engines at record rates, the parts are just bottlenecked.
So to visualize this, it's like imagine you own this really high-end exclusive mechanic shop.
Okay, yeah.
You do flawless work, and suddenly your customer base triples overnight.
Which sounds great.
Right. You're thrilled. On paper, your revenue is through the roof. But suddenly, you don't have enough wrenches
Yeah.
or enough service bays to handle the cars. You're completely out of replacement brake pads for the clients you had 3 years ago.
Right, you're making cash, but you're physically buckling under the demand.
Exactly. So managing this kind of explosive demand usually requires a perfect economic environment, right?
Normally.
Yes.
Yeah.
But if we look at the macro data, the global economy is not exactly playing nice right now.
Not at all. I mean, it's pretty tough out there.
Brent crude prices are elevated. Global GDP estimates have been reduced. And then the forecast for global flight departures for 2026.
Yeah, that's a big one.
It's forecasted to be flat to low single-digit growth, which is a noticeable step down from prior forecasts of mid-single-digit growth.
Right, the revenge travel boom is basically normalizing.
So wait, if I'm an airline executive and my fuel costs are high and global departures are flattening, shouldn't I be pulling back?
You'd think so, yeah. Like, shouldn't airlines be delaying maintenance and holding off on new engine orders to save cash? How is this macro pressure not just crushing GE's pipeline?
Well, see, that instinct makes perfect sense for a standard consumer market. But the aviation lifecycle works on an entirely different set of rules.
Okay, how so?
A commercial jet engine is heavily regulated. Maintenance isn't based on how much money an airline has this quarter. It's strictly dictated by cycles.
Cycles, meaning like takeoffs and landings.
Exactly. One takeoff and one landing is a cycle, Once an engine hits a mandatory cycle limit, it legally has to be overhauled. It doesn't matter if global GDP is up or down.
Ah, so gravity and the FAA just do not care about your profit margins.
They really don't. And this is why GE Aerospace is so incredibly insulated. They power about 75% of total narrow-body departures.
75%.
Yeah, and 55% of total wide-body cycles globally.
That's a massive footprint. It is. But the crucial detail here is their CFM56 fleet. This is one of the most widely used commercial engines ever, produced by their joint venture. And about 2/3 of that massive CFM56 fleet has yet to undergo its second shop visit.
Wow. 2/3. And a shop visit isn't just an oil change.
No, no. Often they have to take the engine entirely off the wing, tear it down, inspect the metal, replace core parts. So because thousands of these engines were delivered over the last decade, they are mathematically guaranteed to hit these mandatory milestones soon.
So GE has this guaranteed, locked-in pipeline of high-margin service work.
Exactly. Actually, the sources give a really great historical parallel. In 2008, during the financial crisis, commercial services didn't crash immediately. They lagged the economic slowdown by about 12 months.
Oh, interesting.
And then that lag was followed by a period of above-average growth.
Because the airlines stopped buying new planes to save cash, so they had to fly their older engines harder?
Precisely.
But wait, having guaranteed pipeline is great, but we already established that parts delinquency is up 49%.
Yeah, that's the rub.
If these engines are coming in for mandatory overhauls no matter what, and GE is already out of parts, how do they physically process all this without creating a massive global traffic jam of grounded airplanes?
Right, they can't just work harder. The demand is too high.
So what do?
They use something called Flight de-Aconic. It's their proprietary lean operating model.
Okay, and here's where it gets really interesting for you. If you've ever tried to, optimize your own workflow or schedule, imagine doing that, but with jet engine turbines.
Yeah, it's wild.
The sources gave this highly specific example from a GE Aerospace repair team down in McAllen, Texas.
Ah, yeah, the LAE HPT repair.
Right, the high-pressure turbine. They reduced the turnaround time for that repair by over 50%.
Over 50%.
Which I read that and thought, how? Cutting repair time by 50% on something this highly engineered that's not just a slight improvement. That is a monumental shift in capacity. You can't just tell mechanics to turn wrenches faster.
No, of course not. That would be dangerous. But if we connect this to the bigger picture, in a supply-constrained world, efficiency is the new currency.
Right.
What FlightTTIC does is target the waste in the workflow. In heavy manufacturing, a part spends most of its time just waiting.
Waiting for what?
Waiting for a diagnostic check, or being moved across a massive factory floor, or waiting for a mechanic to go find the right tool.
So waste isn't scrap metal. Waste is motion.
Exactly. Waste is dead time. So the McAllen team created better flow. They rearranged things so the part only moves a few feet. The tools are right there. By doing that, they doubled their output without cutting a single corner.
That's incredible.
And they're scaling this up. They're leveraging AI to reduce turnaround times across all their platforms, predicting bottlenecks before they happen.
Wow, okay. And they're also throwing cash at the problem too, right?
Oh, big time. They're expanding capacity with a massive $1 billion investment in U.S. manufacturing in 2026.
$1 billion. So
Yeah.
they clear their own backlog, but they also become a much more reliable partner to these airlines who are desperate to keep their planes in the sky.
Yeah, and the airlines are definitely noticing.
Which explains the massive wave of new contracts they just signed.
The big wins.
Yeah. In Q1 alone, they had over 650 new commercial engine wins.
650 in one quarter.
Just to name a few, American Airlines selected over 300 LEP-1A engines for their A321neo and XLR fleet.
Huge order.
Delta picked 60 GEnx engines for its new 787s, and the report noted that's a first-time selection for Delta.
Which is a big deal. When an airline switches engine types, it shows massive trust.
Right. And then United grabbed 300 GEnx engines, making them the largest GEnx operator. Plus, Ryanair locked in a material services agreement for its fleet of like 2,000 CFM56 and LE engines.
It's a clean sweep of the major carriers.
Let me ask you this, though. When an airline like Delta or United drops an order for 300 engines, what are they really buying?
That's a great question. They aren't just buying the metal.
Right.
They're buying Time on wing.
Time on wing.
Yeah, that's industry speak for keeping the plane flying. They're buying a lower cost of ownership, lower fuel burn, and higher reliability.
Because downtime is basically a financial death sentence for an airline.
Exactly. And it's not just the commercial side doing this. Defense is surging too.
Oh, right. The defense portfolio.
Yeah, they had a book-to-bill ratio of 2.4x in defense.
2.4, meaning for every dollar of product they finish, they're booking $2.40 in new orders.
Basically, yeah. The Naval Air Systems Command awarded them a $1.4 billion contract for the T-408 engine.
$1.4 billion just for that one engine.
Right. And then the U.S. Air Force partnered with GE and Kratos for a CCA engine.
The collaborative combat aircraft.
Yeah, those are the drone wingmen.
Wow.
So this is driving a 19% revenue increase in their defense and propulsion technologies segment.
Okay, so what does this all mean? We've talked about a whirlwind of orders, the lean manufacturing in Texas, the macro headwinds. How does all this translate to the financial bottom line?
Well, it translates very nicely, as you'd expect.
I bet.
Adjusted EPS, so earnings per share, for Q1 was $1.86.
Which is up 25%.
Right. And free cash flow was $1.7 billion, up 14%.
Okay, let me just simplify this financial jargon for a second.
Yeah.
Because to me, the biggest flex in this entire report is what they did with that cash.
The share repurchases.
Yes, GE Aerospace executed $2.2 billion in share repurchases. They dropped the diluted share count by 24 million.
It's a huge move.
Buying back $2.2 billion of your own stock is basically the corporate equivalent of betting heavily on yourself, all right?
Absolutely. It shows immense confidence. And they're maintaining their 2026 guidance, too.
Which was what, $42.3 billion in revenue?
Exactly. And they're trending toward the high end of their operating profit guide, which is between $9.85 billion and $10.25 billion.
But with inflation and these huge supply chain investments, like the $1 billion in U.S. manufacturing, doesn't that drag on the profit margins?
It does drag slightly on margins in some areas, sure, but the sheer volume they're dealing with combined with their pricing power.
Because the airlines have nowhere else to go.
Exactly. That volume and pricing power is driving double-digit earnings growth despite those headwinds. Plus, they have a massive cash balance.
A massive.
$12.4 billion.
Right. Okay, yeah, $12 billion in cash is a pretty nice cushion.
It's a supreme strategic advantage in such an uncertain world. They have the liquidity to literally buy their way out of bottlenecks if they need to.
So to summarize this whole journey, GE Aerospace is basically riding this 87% surge in orders. They're fighting massive supply chain constraints with AI and lean manufacturing, like that facility in Texas.
Yeah.
And they are successfully transforming this overwhelming airline demand into just stellar Q1 earnings.
That's the story in a nutshell.
And for you listening, whether you're managing a small team or you're studying global markets, the lesson here is pretty clear. When demand entirely overwhelms you, the answer isn't always to just work harder or panic.
No, definitely not.
The answer is to fundamentally redesign your workflow to eliminate waste.
And that brings up a really provocative thought, actually. This deep dive raises an important question. As companies like GE Aerospace increasingly rely on AI to untangle these complex supply chains and, optimize their factory floors, are we approaching an era where the most valuable asset in manufacturing isn't the heavy machinery itself, but the algorithms that tell the machines when to move?
Oh, wow. That is a fantastic point. The algorithms running the physical world.
Exactly.
Well, we'll leave you with that to think about. Thank you for joining us for this deep dive. Keep questioning, keep learning, and keep looking for the bigger picture. We'll catch you next time.